morning, everyone, and welcome to our DATIQ weekly market update. This is our update for May 9th, 2023. I'm Ken Animo, Chief of Analytics over here at DAT, joined by Dean Croak, who's our Principal Industry Analyst, and then eventually joined by Nicole Glenn, who's the President of Candor Expedite. I think right now she's only representing us through your T-shirt, Dean.
Yeah, exactly. I called in last week and met the team down there at Candor in Dallas and picked up some pretty cool swag.
I love swag. But yeah, she is en route and will be joining us later in the program to talk some question and answer at the end. So if you have any questions for us or Nicole, now might be a really great time to get those into the chat or comment section so that we can cover those at the end. But we do have a lot to get to, so I'm going to move us on to the key points this week so that we can get moving. So dry van spot rates are flat on right around 12% lower volumes. Things seem to be just hovering around current levels. Perhaps that bottoming effect that we've been talking about, although very recently we're starting to see some signs of seasonality starting to emerge. Dry van active contract rates continue to slide. Replacement rates are down 13%. Reads like bad news. In actuality, pretty good news. We need these things to correct before we can get into a new market cycle. The U.S. Bank Shipment Index for Q1 2023 is down about a percentage point quarter over quarter and 6.1% year over year. Interestingly, the Southwest region was the only region to post quarterly and yearly gains. The Logistics Managers Index in April dropped to a new 6.5-year low, mainly due to a dip in inventory levels. We had a guest, Zach Rogers, who prepares this index a few shows ago. You can kind of go watch that if you want a little rundown on what the LMI is and how it works. And then produce seasonality emerging, as I mentioned earlier. National volumes now flat. U.S. Department of Agriculture is reporting tighter supply of trucks in California and Florida for the first time this season, a trend we hope continues this month into next. Dean's going to take it away now with the long-form market update. Dean?
Yeah, thanks, Ken. A little bit of good news there this week in the produce market. Of course, 1 week doesn't make a trend, but it's good news nonetheless. So let's dive into our market update. Let's start with load-to-truck ratio. Load volumes were down about 12% last week. They erased all of the gains of the prior week. Equipment posts are still fairly high. Historically, load-to-truck ratio just under 2 ended last week at 1.84, almost identical to this time in 2019. After being down in the refrigerated category in the 12 to 14% range year over year, national produce volumes were flat last week, which is a good indicator. They're not up, but at least they were improving. Some definite signs that the season is emerging in crucial growing regions as shippers start to push out meaningful volumes. Slight shortage of trucks in the 6 growing regions in California. After reporting a shortage of produce trucks in Florida last week, capacity eased. So we're seeing the typical seasonality we see where it starts in Florida and then it works its way up through the northern latitudes and on the west coast. In the spot market, reefer spot market volumes were flat last week, about 7% higher though than this time in 2019. Equipment posts were up last week, load-to-truck ratio down slightly to 2.81 loads per truck. In flatbed, last week's spot market flatbed volume erased all of the gains from the prior week also, now 16% lower than this time in 2019. Carrier equipment posts were up 8% last week, also at the highest level in the last 7 years, back as far as we've got data. Load-to-truck ratio down to 10.75. At that level in flatbed, it's only been surpassed by 2020 when the shock of the pandemic rippled through the freight market. So some pretty meager numbers there in flatbed. In the market condition index category, dry van capacity continues to tighten in all of our produce growing regions. No surprise there as refrigerated carriers migrate to higher paying loads of fruit and vegetables in the southeast, southwest and west coast regions. In Florida, rates averaged $1.25 per mile last week. And even though outbound rates are up 12 cents a mile in the previous month, they're still about 2 cents a mile lower northbound out of Florida compared to 2019. In the southeast region, rates are up 2 cents a mile to $1.77. It's about 5 cents a mile higher than 2019. In Atlanta, rates are up for the 4th week to $1.66. Having a look at Illinois, after decreasing since the start of the year, outbound spot rates in Illinois reverse course last week. For the first time, they're up by only a penny per mile to $1.92 on lower volumes, 12 to 15% lower volumes. Gains were reported in Chicago and Joliet markets. Rates were up 2 cents a mile in both markets to $1.87 and $1.91. In the refrigerated market, of course, we've talked a lot about the impact of weather. Hurricane Ian in Florida late last year, heavy rains in California this year have certainly delayed the start of produce season, but there are signs that both regions are starting to recover as some higher volumes come through last week. Looking across the 5 main produce regions, California, Florida, and imports from Mexico across the 3 main crossing points, just 689 fewer truckloads were reported compared to this time last year. The prior week, that gap was closer to 5,000 fewer truckloads of produce. So getting closer to the sorts of volumes we see this time of the year from the main growing regions, including imports from Mexico. In Florida, outbound reefer line haul rates heating up, as they always do, up 20 cents a mile ahead of Mother's Day this coming Sunday at $2.20 a mile. Reefer rates have increased by 76 cents a mile in the last 5 weeks, almost identical to 2018 and 2022 produce seasons. Last week's Florida produce volumes were up 12% year to date. Of course, we're into the peak of watermelon season right now, so no surprise there with some of those good loadings that reefer carriers are reporting. In Miami, of course, 90% of this Sunday's Mother's Day flowers will land, and the largest reefer spot market in the nation is also Miami this week. Volumes up 10% last week. Rates were up 12 cents a mile to $2.04. Miami to Hunts Point surged to $2.65. Hunts Point's in the Brooklyn market in New York. That's around 40 cents a mile lower than this time last year, but the gap is closing. According to Ratecast, DAT's flagship product, reefer line haul rates are forecast to peak at $2.90 on this lane. So they're at $2.65 now. We expect them to peak at about $2.90 later this month, just 18 cents a mile lower than this time last year. Having a look at the West Coast in California, reefer rates increased by 5 cents a mile to $2.09, still about 5 cents a mile lower than this time in 2019. And in Fresno, the largest produce market, rates up 8 cents a mile to $1.80. In flatbed, Texas flatbed rates at $2.35 a mile are around 2 cents a mile higher than in 2018, as the state remains an attractive option for all flatbed carriers. Solid gains again reported in Houston. Outbound rates up 8 cents a mile to $2.48. They've been decreasing for the prior 3 weeks. The number of loads moved between Houston and El Paso, the highest volume lane in the state at the moment for spot market, were down 3% last week. Rates also down slightly to $2.75. It's almost $1 per mile lower than this time last year. That's Houston to El Paso. The other big lane that we track out of Houston is loads north to Fort Worth. Outbound capacity was also tight in Little Rock. Line haul rates were up by about 5 cents a mile to $2.59 on 17% lower volume. In Memphis, it's a big distribution market for flatbed carriers. Capacity loosened last week. Rates dropped 9 cents a mile to $2.64. Smaller market out on the West Coast or the West region, Flagstaff, Arizona. Capacity tightened last week for the 3rd week. Rates were up 51 cents a mile to $2.20. Outbound rates in this market have increased almost $1 per mile in the last month. A lot of those loads are heading short-haul regional loads to Los Angeles and Ontario. And wrapping up our market update with our look at spot rates year over year, dry van's line haul spot rates were flat again last week. They've been around this level for the past 3 weeks. Since load post volumes were about 12% lower last week, it's looking more and more like the dry van market may have found the bottom that we've been talking about, as Ken alluded to at the start of the show. At $1.62 per mile excluding fuel, the national average is holding around 10 cents a mile above 2019 levels. That's excluding fuel. Based on the volume of loads moved, the average rate for the top 50 dry van lanes was 21 cents a mile higher last week. It averaged $1.83. In the refrigerated market, after being flat in the prior 2 weeks, reefer line haul rates increased by just under a penny per mile last week, as of course produce seasonality starts to emerge. At $1.91 excluding fuel, spot rates are 2 cents a mile higher than this time in 2019. And lastly, in flatbed, after sitting around a national average of $2.16 for the last 4 weeks, flatbed rates dropped last week by about 2 cents a mile. Line haul rates are 45 cents a mile lower than this time last year. With that, it's over to Ken for the short-term forecast. Before we go, remember you can download this week's long-form version of the market update. Just go to dat.com/market update. It will be uploaded this evening. Over to you, Ken, for the short terms.
Thank you, Dean. Let's pull this up here. All right, so we always start with dry van. This is a 35-day forecast of national spot rates, excluding fuel, long haul only. So the blue line is the historical 7-day weighted moving average dating back to December 1st. And then we start today and project out until 35 days from now, which would be roughly that second week of June, end of the first week of June. So we have 4 forecast models for you. We have the green one, which is RateCast, our flagship model. It's in all of our products. We have a red line, which is a short-term forecast. It's going to more heavily weight more recent data. And in this particular case, it's going to be much more focused on seasonality. And then you see the gray and the yellow, which are, I would say, intermediate blends is the best way to describe them. And what you're seeing here is RateCast, as it's been pretty steady in predicting modest seasonality, modest and delayed seasonality. I think it's coming into focus more and more that that's going to be a pretty safe assumption on a pessimistic view of the next 35 days. I would argue that if we perform much worse than this, we're going to see a pretty substantial capacity exit heading into the 4th of July. I think that is pretty well boxed by the red line, which is more than likely overly optimistic about how rapid things could increase. If I were going to make wagers on national spot forecasts, which I don't know that anyone actually does, but if you were to, I would say that the yellow line is probably the most expected outcome over the next 35 days, which does see rates climbing back up off the floor they're sitting on based on some of these short-term signals we're seeing, but not so optimistic that it tops out maybe in a more typical year type fashion. So let's go to reefer, because I think what's really interesting here is you basically last week, this forecast would have been a mirror image of dry van. And now the models are really starting to come into alignment over what it expects, which is a more modest approach to forecasting seasonality. And what I think is really interesting here, and it'll be very important to watch this over the next week or so, is the weakness it's seeing after Memorial Day. That's not something I would expect. Really, with the refrigerated markets, with being more produce dominant, I would expect that to continue with its momentum to the 4th of July. It's going to be really important to watch what happens here, because if we do see softness sliding in after Memorial Day, I think it's going to be a harbinger of what the rest of the year may hold, especially with this equipment type. Let's go to flatbed to round it out here. Pretty much total alignment through my birthday, anyway, the end of May. And then things start to differ a little bit. RateCast has a bit more long-term trend, I would say, expressed in the forecast. The short-term forecast isn't as much sold on it. Right around Memorial Day, it starts to slide back a little bit. Nothing extreme. I mean, you're looking at a 5-cent box here from high to low, with the two moderate forecasts in the middle almost dead on aligned with each other. So, I think with flatbed, we're seeing a lot of signs that it's going to be slow and steady, and the forecasts are reflective of that. And with the other two equipment types, the more prevalent equipment types for most of y'all listening, a little bit more volatility as we head into the summer months. So with that, I think we're going to move away from the data for a second and get into our question of the week, because I see that Nicole has joined us. Hi, Nicole.
Hi, guys.
What does your shirt say?
So it's the Candor 6-year anniversary.
Oh, happy anniversary.
I know. So that's what we're going to. Oh, Dean's got Candor on today, too. Yes.
No one sent me any swag, so I don't have any swag.
Oh, I will get you some. So it says Hustle, and then it's a Hustle crew member. And then I have to show you the back. It says awesome since 2017.
I love it.
Yeah. So it was our anniversary on Saturday.
That's fun.
Yeah.
Do you want to give a real quick intro? I think most folks know who you are, but we do have some new listeners that join us occasionally.
Sure. So, hi, I'm Nicole Glenn. I am the CEO and founder of Candor Expedite, and we're an expedited company that's based out of Plano, Texas, and we service customers and help them with their first final mile, air freight, expedited ground, and white glove work. Like we said, awesome since 2017, and always on a mission to help people with their time-sensitive work.
Awesome. That's great. Well, thank you for joining us. Yeah. Dean, do you want to hit us with the question of the week so we can get right into it?
Yeah, let's dive straight in. So, Nicole, freight demand has been flat at best this year. Some of the recent earning calls from LTL carriers have sort of been saying that the spring peak has been missing so far this year. How are you seeing the market?
The same as that. So it's been more work for the same amount of work, I should say. So now that we've stepped into the multimodal piece, which we call like the expedited LTL, first and final mile, we've seen an uptick in that sector of our business. But the standard expedited ground and air, there's definitely been a decline there. So we see our team consistently really doing, I call it the double trouble, right? The hustle for the same amount. So it's just been holding steady, but again, with way more work behind it to keep it at those levels and numbers. Our average revenue per shipment has dropped at least $300 monthly per shipment. So that all goes into it, right? Even on the expedited side, for sure.
It's something we heard a lot at TIA, right? Which is, first of all, record-breaking TIA attendance, which should give you an indication of the health of the brokerage market. But moving less freight, higher margins, sort of treading water as it pertains to total bottom line revenue. And I think that's really important because it puts a lot more emphasis on making the right pricing decision, right? When you're moving a crap ton of freight, you can afford to have some misses here and there. When you're moving less freight, it's super important that you maximize value out of each shipment, or else you don't have maybe the next couple dozen shipments to back it up, right?
Sure. And I always stress this, and everything I talk about is really utilizing your relationships, right? Being transparent with your clients, really working with your carriers, trying to just do business the best way and the fair way. And that's what we're seeing too. I mean, we haven't lost any customers. It's just that their trends are down. And so you have to then get creative with solutions and think about different things that you can do during those times to still maintain who you are.
Nicole, one of the things I watch and have been for many years is the global air cargo market. That's principally air freighters, not so much belly cargo, but air freighters. The World ACD report from the first quarter shows that chargeable weight on the air cargo side is down about 11% in quarter one compared to quarter one last year. But when you look at origins out of the Asia Pacific region, down 16%. It's a pretty big drop.
Sure.
In the first quarter. Are they the sorts of numbers you're seeing in terms of lower volumes?
Well, for us, this is our first full year in air cargo domestic. So we haven't seen, we're in a build spot, right? But from what I've heard, when we walked into customers last year, yes, significant need, significantly different walking into it this year. But for us, it's just hard to compare, Dean, with it being such a new service offering to us.
Right.
I think it was a capacity issue. And that was one of the reasons why we were stepping into the space. We had a lot of potential and current clients saying that they were having a ton of issues with getting all of their cargo in one spot. Because it was consistently being broken down and then flown on multiple flights, and you didn't know when you'd get your full shipment. But when I walk into current customers now, I'm not hearing issues such as that any longer.
We're hearing some of the big air cargo freighter companies idling capacity, which is a complete 180 from a year ago.
Yeah, I mean, we had customers that were like purchasing the whole plane and trying to almost do their own consolidations, right, on a plane. But we still see the demand for it. And then we also are asked for more charter services. But again, walking into this space with a year under our belt, probably not the best person to tell you the true landing right now. Yes.
Okay.
So as someone who has seen ups and downs, right? I mean, I think that's kind of the interesting I've found in some of the analytics or the armchair analytics that have been going on is people that came into the industry in 21 and are like losing their mind if the market would ever go down. Do you think that we're at bottom, or do you think we still have some room to move downward before moving into a new upcycle?
Well, having dinner with Dean the other day.
Hey, no leading the witness.
Right. So listening to some of the concepts that are happening in the produce market and what he was speaking on, I'm not really sure. I have been in this industry for 23 years, so I have seen these types of cycles happen, right? So again, it's one of those things that you're going to have to just keep playing the game and seeing what you get. And I do feel bad for the people that walked in from 2021, because I see this as normalizing. That's how I always talk on it. I don't see it as this crazy bloodbath, everyone run away from the industry. We're a cyclical market. We're a cyclical industry, and it's going to be consistent. But the folks who walked in and saw it as easy, it's never really been easy. We have little windows of easy, but it does transition back to, do you guys remember consistently shipper of choice comes out, and then it's the carrier's market, and it just keeps flipping back and forth consistently.
Yeah, I mean, I took a really big intellectual risk and went on record a few weeks ago and said that sometime in the next 12 months, the market will go back up. And I know that I'm just really sweating that prediction because, I don't know what the opposite of a bloodbath actually is. I need to figure out what the antonym of that word is. A holy water shower? I don't know, something.
Yeah, I mean, for me, I really don't see it staying here this long. That's my concept. Even walking into this year, I always thought by like Q3, Q4, we would see an uptick again. So from
there's always
February, we do see that already again, like from January.
This is unfortunately like the most. There's like when the market's going up or down, like when you're on the actual slope, I think you lose that sense of speed. It's like a roller coaster, right? I think at the absolute top of the market, when you sense it flip, you get that pit in your stomach, right? Because you're like, oh. Like if someone's going to be the last one to realize the market's going down, right? Someone had to be the last one to buy a truck, a used truck for $200,000 with bad insurance and a poor finance plan, right? So someone had to be the last one in and the first one out. And I feel like right now is also another one of those painful pits in your stomach where you're coming down the hill and it's kind of really going to jerk back upwards, right? Like you won't want to be the last one to close your doors and then all of a sudden the market starts going back up next week. Those are the two toughest parts of the market, in my opinion.
Sure. And I've talked to a lot of the different leaders who are in regular truckload brokerage, and some of them are looking for the ability to scale right now. So the talent market is open and amazing. And so I think a lot of companies are analyzing who's on their team, who can help them when it flips, and kind of having that strategy behind it. I mean, when we post a position now, we get hundreds of candidates trying to apply for it. So again, during these types of times, it's really the hustle and the grind, like I keep saying, but it's also for companies to really assess and maybe capture that talent that they had no way of capturing last year.
Yeah, we're seeing it with software too. I mean, like with all the tech layoffs and everything, it's been at all levels, whether it's executive, director, entry level, we're seeing it's just much, much, much easier. We usually, one of the things I've looked at here and in my prior life is like the percent of hires that we have to go to outside agencies for. Mm-hmm. And I'm embarrassed to even share what it was during COVID, but and the Great Resignation. But now I think we're running at like less than 1% agencies, that we're using. So
yeah,
I think that's really indicative of the softness of the market.
With software too, people who are trying to implement a new TMS, in my opinion, this is the best time to do it. Because you are not in mayhem. You do have the bandwidth. You can make a transition. Right. So that's what we are actually looking at right now. It's like, okay, let's do that before things go batty. Let's implement something new and make these changes that are foundational changes to the company, but that will help us when things kind of turn around and get us prepared for the next level of growth.
Yeah, and I love your point. It's like we should get shirts made that just says "Freight ain't easy," right? Like,
yeah,
genuinely, and I can say that I've only got a decade into it, but 21 and 22 are the only periods in my experience or the experience of anyone I've ever worked with where you could genuinely say it was easy to make money, right? I could have probably got my CDL. I don't know anything about actually doing that work. And I could have probably been profitable for that 18-month stretch, right? Just signing up for DAT and finding loads. And I think what you're finding now is it's not easy, right? Because even at 18, I found that, it wasn't there was such an extreme capacity shortage and ELDs and everything was like, coming together. Like there was a very acute reason the market was whipped into a frenzy.
Yeah.
And we're just finding that freight isn't easy. It hasn't been easy since deregulation, right? So we're running on 43 years of freight not being easy.
Right. That's what I was saying. It's very cyclical. And we did watch a lot of people step into it. And we had a lot of people that joined our company that had never been in freight during that time. And so it's a constant conversation on always being uncomfortable. I feel like that's what the market is. You're always uncomfortable in some manner. Either you're uncomfortable with what you're making, prices, who you have on your team. You're uncomfortable with capacity. I feel like the word is the industry is always being on your toes and being uncomfortable. But the fleets that did start during that time, I mean, a lot of brokerages have these rules and kind of policies that they only work with fleets that are a certain age. And I wonder what that looks like now. They were probably just grabbing anything they could for capacity at that time. So even people who are entering into the marketplace with the hustle mindset, if they're being turned away a lot more often, because they may only have been in business 9 months, 10 months. What does that look like for those folks? I'd be curious.
Yeah, it's like through no fault of their own, people have been able to become a lot more picky, over the last 12 months. It's an interesting, I find it, I come from energy, right? Before freight, I was in regulated energy, and there's like not a lot of emotion tied to it, right? Like you don't walk up to a natural gas plant operator and find them complaining that Standard & Poor's is setting prices in the market, right? Like they understand the supply and demand. And if it's an abnormally hot summer, they're going to make money. If it's an abnormally cool summer, they're going to lose money or not make as much money. I find it interesting in freight that there's still such a high degree of emotion and irrationality, right? No one's setting the current prices. I mean, the only thing that's setting the current prices is the intersection of supply and demand. Mm-hmm. And it's unfortunate that the current levels are lower than profitability requirements for some fleets. But again, there's no boogeyman here, right?
Right.
Nicole, one of the questions we get asked a lot is, are there any particular sectors that are hot? Right now we've got a fairly well documented decrease in single family housing starts. So residential housing construction has dropped about 12% when you look at the amount of money being spent. But the flip side is the amount of money being spent on commercial non-residential projects is at record high levels, up 28% of the last year. So we're sort of hearing on the open deck side that there's a lot of carriers doing pretty well in the specialized flatbed market around construction projects, whereas a year ago they were doing well with housing related, flatbed lumber, roofing shingles, things like that. Anything in the expedited LTL world where there's a particular commodity that's doing really well versus others?
Well, I mean, we're still seeing very high levels in the medical sector. Right. So if it's equipment or machinery, yes, we are seeing that there. I did read an article yesterday that said the hotel industry for remodels is on a huge uptick, as we've seen a lot of companies or people are traveling. And so it's creating a lot more need for logistics in that space.
Airports too. Yep.
Yeah. And so for us, I mean, it really has been the medical sector and as well as the tech side of things. So with our first and final mile with the white glove work, I mean, we're still seeing that strong transportation need for, say, server racks, anything to do with technology devices being installed has been good for us.
Right.
Yeah.
Right. Very interesting.
Mm-hmm. All right. Well, I guess my final question is, I saw on LinkedIn, I think it was, that you were in Pittsburgh a while ago. You posted something. So I was born and raised in Pittsburgh. What was your favorite spot in the city?
Well, I can't tell you the areas. I don't know. I'm like not a native. But when I actually went down to the city, like into the city, I stayed in the slopes. Do you know what that is?
No.
Okay. See, I don't know either. But I stayed in an area that was really old. And the cool part of it, the places that I stayed in, it was like, it had to be from the 1800s, this house. And it was just so bizarre on the layout of it, where it was like multiple floors and it had to be a repurposed something.
Right.
But when I did go into the actual city, there were some cool spots down there. I can't tell you where they were though. It's like, that was my very first visit, but I did get to see my Blackhawks play the Penguins. So it was
nice. Yeah.
It was a fun
trip. I'm a diehard Penguins fan.
Yeah.
I will say that we went and visited ARL down in the Strip District of Pittsburgh, and
So did I.
it was fun because
Yeah.
I got to kind of show my team around. But it's just changed, right? So the Strip District used to be where the vegetables would come in, like all the terminals that used to be on the river were for the fruits and vegetables and meat. And then Woolley's Fish Company was where the fish would come down the river and frozen and get put into this giant, these big freezer buildings. And it's just changed. Now it's like $4,000 a month loft apartments.
Yeah.
So it's for me, it's a little sad to see some of old Pittsburgh go away for these super bougie upscale developments. But then you see that with Carnegie Mellon and all these other places, this is fueling a massive investment on the tech and engineering side, especially biotech. It's just the Sydney's, I'm an Ohio transplant now, and Cleveland's just an absolute dump compared to Pittsburgh. I mean, just like all sports teams and everything aside, it's just when you look at what like two blue collar cities that were completely eviscerated by the kind of second industrial revolution and what Pittsburgh's been able to do versus what Cleveland's been able to do, it's just night and day. But also, all Cleveland sports teams suck.
See the group at ARL. I also had dinner with Christy Knitchell from Knitchell Logistics, and she was explaining to me outside, like we went outside of the city, and she was telling me she's like born and raised there. She's like, none of this was here. So she's like, it's consistently changing here, but it's a fun city to go hang out and do some cool stuff for a couple of days for sure.
It is a great town. And Cleveland's good too. Don't hear me wrong. For everyone that we have up in Cleveland, we love you, but we hate your sports teams and they're awful. And I hope they always lose. All right. So, and your Blackhawks just got the first lottery pick in the NHL draft. So that's awesome.
Yeah.
All right. 2 quick questions. Any openings at DAT I want to get hired? Sure. careers.dat.com. We've got a bunch of listings up there, mainly in the product and tech space. We may have a stray HR or finance position. I'm not totally sure, but we are still absolutely growing. And then you want to take this one from Andrew Webb, Dean?
Yeah, data continues to come in showing that truck transportation jobs continue to climb, albeit at a slower rate. What are your predictions when capacity begins going down? I think it depends how you measure capacity, Andrew. Truck transportation jobs, if my memory serves me correctly, it doesn't include owner-operators. So what we tend to look at, or I certainly look at more closely, is the number of DOT carrier authorizations that the FMCSA reports. And we've been losing more of those each month than we've been gaining since last October, albeit at a decreasing rate. So the large exodus of carriers, as we measure it in the interstate sector, really started last October, accelerated through January, and then has eased off. But we're still losing more carriers than are coming in or reactivating their authorities. So I think we look at the number of authorities for vehicles over 10,000 pounds, largely because the truck transportation jobs certainly don't, in our opinion, capture all of the entire market. In the spot market world, of course, a large percentage of our carriers are owner-operators. They represent about 30% of the trucks on the road. And I don't think that's, I think there's no more questions. Am I right, Ken? I think that was it.
Mm-hmm.
Yeah. All right. Shout outs.
Why don't we start with Nicole?
Sorry.
What'd you say?
Do you have any shout outs or plugs?
Yeah.
I don't know. You go first. I need to hear what we're shouting out to.
Okay. Yeah, sales chatter tomorrow. I'll be on Day-to-Day Wednesday with Ryan Muhammad and Dan Deeg and Jeff Dickinson. We're on Landline Now tomorrow night. I'll also be on Radio Nemo with Ginny Mack on Thursday morning. Both of those shows are on Sirius XM Channel 146 Road Dog Radio. Don't forget, Freightvine is out. Mark Levinson, famous author, is talking about supply chains and the movement of physical goods. On this week, of course, is the Gartner Supply Chain Expo in Orlando. Swing by booth 601. Catch up with our DAT IQ shipper team. And just a reminder, next week is Road Check Week. The focus this year is ABS braking systems and anti-lock braking systems and cargo securement. That'll be on next week. It'll be interesting to see whether we see the typical dip in capacity. My money's on carriers maintaining their activity and taking less time off than they normally do because things are so tight. But we'll report on that the week after next.
How can folks get a hold of you, Nicole? Maybe that's a different question. That's
perfect. Because I'm like, I've been laying low since conference travel, so it's been a nice little holiday. Well, if you want to get a hold of me, I'm always active on LinkedIn. It's just Nicole Glenn. You can search me there via Candor Expedite, or you can give me an email or shoot me an email. It's nglenn@candorexp.com.
All right. So we will be back next Tuesday at 10. We want to thank Nicole for joining us. We'll have her back on next quarter. These are always awesome discussions. If you see our crew out at Gardner, make sure you stop by and say hello. But with that, we're going to sign off. Have a great week. And remember, as Dean said, Road Check Week is next week. Hopefully that helps usher in some recovery in this market. All right. Bye, everyone.
Bye.
Bye-bye.